What's up traders? If you're new to the channel, I'm a top author on the TradingView platform and I'm a Forex swing trader. Now in this video we will be speaking about Euro AUD. We will make a full breakdown from the monthly to the 4-hour time frame, and specifically we will be speaking about why it is important in the market to be reactive and not predictive. Without further ado, let's get into it. Okay, so let's start by defining what you're supposed to be looking at from the monthly to the 4-hour time frame before executing a position as a swing trader. So the two questions you're always supposed to ask yourself is, where is the market going? Are we in a support or resistance area? And what kind of pattern the market is creating? So regarding the pattern here, starting from the monthly time frame, on Euro AUD you have a very big push to the downside, very big impulse to the downside, starting from this high and ending down on this low. Now this impulse took many years, from November 2008 to July 2012. So as you can see, this big impulse, after this big impulse, what we had is all of this consolidation period, and all of the price action that we have, we basically had in the last years, was all inside of this move. What I mean inside of this move is that it was inside of this range of price. So the pattern here that we have is the most common pattern in the market. You have an impulse, then you have a corrective phase, and then you have another impulse to the downside. Very simple pattern that you have very often in the market or across all time frames. So when you want information on this retracement, what you're supposed to do is basically take your Fibonacci on the impulse leg, so from the high to the low. That is what you're supposed to do, basically to have information on the retracement. And what I mean by information, I mean that you want to know which are the strong resistance levels basically on this move to the upside. So where the market could actually shift and start the next impulse to the downside. So let's take our Fibonacci from the high all the way to the low of this huge monthly impulse. And that is something you're supposed to do every time you have an impulse to the downside. If you want information on this retracement, you need to take your Fibonacci from the high to the low of the impulse leg. Now, if you do this, what you actually realize is that the market is rejecting a very strong resistance level. In other words, it is rejecting the 50% retracement. Now, the 50% retracement, strictly speaking, is not a Fibonacci level, but it is half of the move, and many times the market will make an impulse, retrace half of this impulse leg, and then start the next push to the downside. So basically, sometimes the market fails to reach the golden ratio, aka the 0.618. So what can we expect is obviously for the market to react to this level again, because as we know, the market loves to react to the 50%, and you can clearly see it. The market found resistance here, resistance here, resistance here, and is currently finding resistance here. Now if you zoom in, you can clearly see that the market has hit also during this month the 50% and has already rejected a little bit to the downside. So another thing that you're supposed to keep in mind is that for many reasons, this pattern here, this candle here, this red candle, usually leads to the next candle filling in this wick. And this is a pattern that you see many times in the market. This kind of candles here that have this characteristic shape usually end up being a candle that gets filled in by the next candle. So we can expect this month the market to continue to the downside after testing the 50%, which it has already done. Now going on the weekly time frame, so scaling down one time frame, let's see what kind of price action we're getting. So you can immediately see that if you follow the movements in the market, and that is exactly what you're supposed to do, you can clearly see that you already have resistance. Now if you look at the market from a pattern perspective, you have up, down, up, down, up, down. So you have an F formation here. After an F formation, you're expecting this push to the neckline. I had already basically told you guys many times to expect this push to the upside, and that is exactly what happened. The market went for the retest of the neckline of this M formation. The market went back up, and we can now expect continuation to the downside, basically creating a pattern inside a pattern, because you can see that you have a head and shoulders here, and you can also see that you have an affirmation with the retest of the neckline. Now, what do I mean by a retest of the neckline? In other words, can be simply translated into retest of the previous support, not to resistance. What I mean by this is a very simple concept that there is in the market. If you have a high, the market goes down, so basically the market found resistance around this area. When the market will break this area to the upside and go back down to retest it, this area of resistance will basically become support, and the market will find the impulsive power that it needs and the liquidity that it needs to continue the push to the upside. So basically what we can expect from this area is continuation to the downside. So what we see from the monthly and weekly time frame is a clear sign of a bearish direction on the pair. We want to see the market create a low, basically a lower low, so a low here that is lower than this low here. We want to see this push to the downside. Now, how do we take the target on this push to the downside? We can simply take our Fibonacci from this high to this low, because basically if we want information on this new impulse, we need to take our Fibonacci on the retracement. So by doing this, you get the first target, that is the minus 0.272. So your first take profit on this impulse to the downside will be just above the minus 0.272, or like I like to call it, the minus 27. So this will be your first target for the pair according the monthly and weekly time frame, especially this weekly retracement, because if you want information on the impulse, you need to take your Fibonacci on the retracement. So switching down on the daily time frame, what we get is that clearly we have a contradicting scenario. This is the first time we have a contradicting scenario, because from the monthly we know that overall the market is supposed to push to the downside. From the weekly we know that overall the market is supposed to push to the downside. But what we get here on the daily time frame is, even if we have our swing target to the downside, what we realize is that on the daily we are in an impulse correction scenario. We had a very nice impulse to the upside, we had a very nice retracement, we were expecting continuation to the upside to create a higher high. So this is why it's so important to trade in a reactive way rather than a predicting way, because we know that the market is supposed to push to the downside. So what do? Since we are predicting that the market will go to the downside, many traders, new traders, will just start taking shorts all in the way. It's not really relevant from where they take it. They will take it regardless, because they know that basically they have a swing target to the downside, and that is a very bad mistake, because you always have to react to what the market is showing you instead of trying to predict where the market will go. Because here in the daily you can clearly see that the market is showing you that it wants to continue to the upside. So what will be a reaction that you can have to what the market conditions are showing you? What you can do is very simply, and what you should do is basically the exact same thing that we have done on the monthly and weekly time frame. So basically understanding what kind of price action we have. So are we in a resistance or support area, and what kind of pattern the market is showing you. So regarding are we in a support or resistance area, it's pretty clear that we are in a resistance area. The market had found resistance here. The market had broke it to the upside with these huge impulsive candles, and then broke it back below, and now the market is inside of the area, so basically retesting it. So what can we expect? What basically can produce a reaction to what we see instead of trying to predict? Very simply, if this daily candle here that we are trading in at the moment will close above the area, above this box that we have taken, then obviously we are not interested in the short anymore, because we can expect completion of this impulse correction impulse pattern. On the other side, if this daily candle will retrace and all of this push to the upside will be a wick and the market will basically close back below the area, then what you should do is go on the 4-hour time frame and look for an entry. Why do I say this? For the simple reason that the market at that point has created kind of a head and shoulders formation, because basically what a head and shoulders is, in other words, is a fake breakout of a strong level. Many of you will just say yes, but the neckline, basically these two lows must be at the exact same levels to be defined as a head and shoulders. But if you look at it from a broad perspective, what a head and shoulders is simply a fake breakout of a level. Let's say you have a horizontal structure level here. The market goes up, finds resistance, breaks the resistance to the upside. At that point, what are you expecting? You're expecting that resistance to become support. And instead, what the market does, the market goes up, moves to the downside, finds resistance, breaks above, and when it goes for a retest of this level, instead of finding a support where it previously was resistance, the market breaks back below. Now, this break back below basically confirms that all of this push to the upside was a fake breakout, and then the pattern that all of you call head and shoulders will happen. But in other words, it's just simply a fake breakout of a level. And we can apply this concept to what we have here with the current price action. What we basically have is the market creating a resistance level here. The market closes above and then shows us that this was a fake breakout because the market closed back below. And yes, we didn't make it all the way to these lows, but overall, now we are retesting this area again. So it's very important to see how this daily candle will close to determine if we will have a reaction from our side, so basically us going on the 4-hour time frame to find an entry or not. Now let's basically just give a little bit of an insight on what's going on the 4-hour time frame. Now we know on the 4-hour time frame that if we look for structure, we had a structure level here because the market started from this low, went up, down, down. So the previous support, now turn resistance, was around this area on the 4-hour time frame. But we know that we had a very strong impulsive phase from the daily time frame. We already know this. So what basically would mean a valid entry on the 4-hour time frame? Basically, we need to see the market break back below this area, and then we can expect further continuation to the downside. And in this case, obviously, the 4 hours aligns with what we want to see on the daily, as it should be each and every time. Because what will happen if now the market prints a nice red candle, that is one of the, probably the only condition that would generate a reaction from our point of view, is that if the market now shows us a strong rejection to the downside, a strong daily candle, it will mean, obviously, that this daily candle will close back below the level, will close back below the level we had found here from the daily time frame. So basically, as you can see, at that point we have also the confirmation on the daily time frame that we wanted to have. We can drop on the 4-hour time frame, and at that point you can take your trade and you will have a very good risk to reward. Why will you have a very good risk to reward? Because you can just, we have some special rules for this, but you can just put your stop loss above the high in a very basic way, and you will still have a 1 to 6 risk to reward if all the conditions will be satisfied. So that is why it's very important to be reactive and not predictive. You know that the market is supposed to push to the downside. Perfect. But if the market is now showing you something completely different, it's showing you that it is not ready at the moment to push to the downside. So wait for the market to show you and then react to what the market is showing you. Don't try to predict, always react. And that is a very important part in trading. I hope you enjoyed the video. If you did, make sure you leave a like and a comment to the video. This supports the creation of more content just like this one. And if you want to learn our strategies, so the ICI strategy, the WM strategy, and the TLCTL strategy, so you get access to the exact rules of the strategies as well as the training and everything involved, make sure you go check out the website, so www.transparentfxtrading.com, and you will see all the services. Also, if you have any questions, you can hit me up on Instagram, on WhatsApp. You can see all the contacts also on the website. Make sure you subscribe to the channel, and I will see you in the next video.